Just before I go to him, I just want to bring out the YTD graph of the IT index and the bank index. And for me, those are two important indexes which I'll want to discuss at length with Atul Suri. Atul, fantastic to have you back. Thank you for joining us. A tough Monday, but I guess that tough Monday was necessary. Based on a tough Monday, are we in for a tough quarter or a tough second half?
Nikunj, we must remember that we've had a dream run. From COVID bottoms, the market has almost rallied 130% plus. So it has been a crazy, outlandish, unbelievable one and a half year. And this has not just happened in India, it has been global in nature. So if you look at the all country world index, global markets have actually had about 100, 110% kind of move. India has been the best performing market, whether it's from the COVID bottoms or whether it's on a 3-month basis or 1 month basis or whatever. So we have been a total spectacular outperformer as far as the whole global market scenario goes. Now we went back and realized that, hey, is this like something out of the box? Is something happening which we haven't seen before? And we realized that whenever markets crash, whether it was the 2000 IT crash where the markets fell about 50%, or 2008, the financial market crash where markets fell about 60% plus, the markets always recover in this spring-like fashion. So in the year 2003 to 4, we had a very, very big bull market, and that was about 120%. Then in 2009, again, post that, we had a market that went up 180%. So the market always in the first phase after a big crash has similar spring action. But obviously, we all know that this momentum or this kind of action cannot continue. So post these, what we observe that the markets take some time. They have a consolidation and they may spend a few months sideways. And the index levels that you have seen earlier may take some time to come off. So the thing is that I personally feel that we are getting into a consolidative phase. I see that the markets are not going to, there's no massive negative news. I mean, you have Evergrande, which is there, but always the market will throw up some things when the days are down and throw up something good when the days are up. But as long as there are no big triggers, I feel that global markets and more so India would go into a phase of consolidation. And this consolidation will be more time-wise. Again, after the 2004 pullback, which I mentioned earlier, you realize that we took about a year. 2015 was a sideways market, 2004-5. Similarly, after the 2009 move, the market spent about 3 years sideways. So markets post a very big rally need time to consolidate. They need time to correct. And I personally think that we will have a time-wise correction. However, the interesting part is that when markets go through time-wise correction, that doesn't mean stocks don't do much. In fact, what happens in the first stage, like we've seen, everything goes up. In fact, the more beaten down a sector or a stock, it tends to do better in percentage terms. But post that, when we go into a consolidation, you realize that markets tend to bifurcate. And some sectors, some stocks do very well, and some don't do very well. So I guess we are heading into that stage where the market will start having a differentiated character rather than everything going up together. Some sectors will do well and some will not do well. And as I said, we have gone back and seen that this has historically happened after crashes. There are 3 stages in a bull market: a vertical climb, a consolidation, and then the next rally continues. So I feel we are somewhere ending the first leg. I feel we should get into a phase of consolidation. However, I still think that there's money to be made because here stocks will actually show differentiated character, sectors will show differentiated character, and this is where stock picking or the portfolio manager's skill will matter.
There are two popular sectors, Atul. One which saw a fall yesterday and the one which has not seen a fall, IT and metals. What should traders who bought the momentum, who have made money in metal stocks and in IT stocks, or maybe both, should do now? Get out of positions because we are going to hit a slow patch.
So again, two sectors which have been in the forefront. Now, IT has been a rank outperformer, and not just in India, globally. I mean, the Nasdaq has outperformed the Dow or has outperformed the S&P 500. So technology sector indices world over, and this has been the big trend that has really happened. So there is no doubt. Again, the risk is that, oh, because they have run up, they will correct. Yes, they will. But early leaders or early breakouts, which technology has shown, very often become the mega trend of the rally. So I personally think that for a trader, yes, there are always stop losses and levels which everyone has. Fair enough. But if you are a strategic investor, if you're looking for the longer term, I feel that sector that one has to be overweight, in fact, is IT, and maybe use the fall to, accumulate into something, see how stocks are behaving. And of course, we are getting into the numbers season. So we will get much more clarity in the next few weeks. As far as metals go, metals are subject to global prices. It's not that anything specific happens in India. It is actually the movement of the underlying commodity globally. And more than metals, I take a step back and look at commodities as an asset class, because that is very important, because commodities have an influence on inflation, which have on bond yields. We can discuss that later. But when I look at the commodity index, which is the CRB index, I personally think that this is just a correction in a bull market. Since 2008, you will see commodities had a singular down move till all the way to 2020. So we had almost a 12-year bear market in commodities. And what commodities have done is actually broken that trend line. Always, as I said, the first phase when markets or any asset class or any tradable stuff, it always tends to be fast. Like commodities also doubled. I think the CRB went from 100 to 220 or thereabouts, another 120% return. It cannot keep up with that pace. But I feel that just as we have ignored commodities for the last 12 years because there have been in a bear market, we cannot ignore commodities now. They have broken the trend, and you will have cycles, whether it's metals, whether it is crude, they are no longer going to be asset classes you can ignore. So for a trader, I still feel that commodities will be an interesting place. The only problem is that commodities, unlike IT, are very, very fast moving and chop both ways very fast. So one will have to be a very skilled trader. But in terms of asset allocation, definitely IT is a place I would like to be overweight. Metals, probably the volatility is a bit too much for me, so I'll avoid that. But great for traders, so each one can use whatever strategy they want. But the longer term trend is definitely in IT.
Okay. Atul, on a scale of 1 to 10, to your mind, what are the chances that we've seen the best for the year? For the index?
No, I won't give it that kind of number that we have seen the best of the year. Because what I feel is that at an index level, we may not do substantially unless we have some fantastic triggers. But at the end of the day, ultimately, we are not invested in the index. We invested in stocks and sectors. We spoke about IT, we spoke about metals and things like that. I feel that a lot of sectors will continue to make new highs. The risk is that also, on the flip side, it's like if you say the index is going to be in a range, yes, something is going to gain, then something has to give way also. I feel that a lot of sectors may also give way, and that's where the risk is, because a lot of people get sucked into these, towards this level. You get a rotation trade, like someone says sector that I'm underweight, autos. I mean, I'm not very bullish on autos, and you'll find that from time to time, you have a story, a saying, someday a auto stock moves and people get sucked into it. So this is that space where Nikunj, where the index per se, like, we can't expect what happened last year to continue. It may be range bound, I think. However, in that, for investors, for traders, there is money to be made. Look at those spaces where there are trends. Some sectors we spoke about. There are many other themes also we can discuss, which will make money, but also use this opportunity of a very inflated market to get out of stocks which may not be very good. And how do you differentiate between good and bad? I think it's earnings. I feel earnings is going to be the differentiator of outperformance of portfolios and stocks in the next phase, which is a consolidation phase. And wherever, which is just going to be hope or storytelling or a WhatsApp forward or on some group, and there is no earnings to back it, I think that can give way. So we will get into a phase where the market, as I said, will be the K-shaped market or the K-shaped recovery. Till now, we just had a V-shaped market, which just kind of went up. Everything went up. But I feel the market will now start differentiating. And that has been the nature of consolidations when we went back and studied 2004-5 or 2010 to 13.
Sure. So, Atul, given that the froth has begun to come off, and historically one has seen that even in raging bull markets, we can fall 10 to 15%. What is your own sense, if you were to really stick your neck out, on how steep the fall could be from these levels?
Aisha, there should be triggers. See, if you see in 2004, we had a raging bull market in 2003, led to 2004. And in 2004, we had a change in government. And there was a change in stance where, the whole divestment process was supposed to be stopped. And if you go back, the 2004 fall were just 2 days when the market hit circuits. And then after that, it recovered the whole thing. So there have to be triggers. Markets will just not collapse or fall. Markets, I feel, at the moment are set to go sideways. I don't see any triggers per se to tell me that. As I said, if you're in a range, you need triggers on both sides. There has to be some massive upside surprise for these ranges to get broken out, or there has to be something very negative. If I look at the markets right now, I don't really see much. That is why I feel they will go sideways. And I feel the markets will have a time-wise correction rather than a very big price-wise correction.
Fair point. Could the trigger really, Atul, come in from something global? I mean, if you were to look at the charts of the US equity markets overnight, clearly it seems that risk off is back. Of course, there is Evergrande as well, which led to the fall in Chinese property stocks. But that aside, you've got the all-important FOMC meeting as well kicking off. Many believe that come November, there will be taper, which is going to come back. So, in that sense, a lot of developments which are going to impact how the bond yields move from here, and thereby the overbearing risk on equities. And you track the global markets as well very carefully. What's your own reading?
I mean, absolutely, you're right, Aisha, that, if I feel or something that I look at is what are the global triggers. And I think the global triggers are not going to be in equities per se. As I said, that yes, the Dow and S&P are all going to be correct. So that's fine. You have overlap, good days, bad days, pullbacks. Those are normal day-to-day things which go on. But I think that the big thing that really matters to me is inflation. Because in US, the whole discussion is that is this inflation, which we are experiencing even in India, is it transitionary or is it structural? The Fed feels it's transitionary, and that's been their stance, and that is how they have been handling monetary policy. But a lot of people also feel, especially some of the economists feel, that it is structural in nature. So in case inflation tends to be more sticky or tends to be more aggressive and violent, I feel that that is what could affect the bond market. And one has to remember that for the last decade or more, uh, the single cause of the rally in global equities has been in bonds. So if the bond market has been vertical left downward for almost like a decade, 12, 13 years, similarly, equity markets have been. So there's a very good inverse correlation on a decadal basis. So the big risk to the market is obviously going to be bond yields. But in all these problems, whether it's Evergrande or whatever, one thing that I keep noticing every morning is that the bond yields have been fairly well behaved, and hovering around 1.34. They can go up. I think 1.74 was a recent high. I'm talking about US 10-year bond yields, and I think 2 would be a very big number to play with. So I think that this is kind of a range. It could play out tightening, no tightening, Fed statements, but the bond market is going to be the clear lead indicator. And if there's one single data point I need to see or need to look out for, is going to be the play out in bond markets. So commentary will happen, narratives will come, opinions will come, but ultimately the market speaks. And I think the bond market is a very intelligent market. Probably one of the biggest markets in the world is the US bond yields, and a very big influencer. So I think if they remain tame, if they remain well behaved, I feel equities as an asset class don't have any major risk. But yes, the big risk is inflation, which will lead to bond yields spiking. And that's the time when I would be worried on the asset class or a need to move into cash and things like that. Till then, I think we will have some good days and some bad days, some good sectors, some bad sectors, some good stocks, some bad stocks.
Good morning, Atul. So just taking forward that point, when you're saying you watch out for the bond yields every day, it impacts the US dollar index, right? And then what happens to the defensives like IT and pharmaceuticals? It's a point you and Nikunja touched upon very light earlier, but will that also not have a big impact?
No, I don't think that you're going to have it all suddenly happen in a day. These are pretty self-correcting mechanisms. It's not that bond yields will go from 1.34 to 2 in a single day. It is a very gradual process. But even the move, from asset classes is not a one-day decision or a single point decision. I feel that it is going to be more gradual, and definitely the market will move on to the risk of trade in case you start seeing these kind of bond yield risks or things like that. So that would be more step number two. The bigger step or the bigger issue is really where I need to come back to is actually inflation. As I said, we are running ahead. I feel that if inflation remains and it shows or it demonstrates that it's transitionary, I feel that bond yields could actually have a leg down, and that could fuel another big rally. So as I said, the decision point is out. The question is that is this inflation transitionary or is it structural? I think once the Fed answers that, we could have much more clarity. And as I said, that every morning I tell people when I wake up, I don't look at the Dow or I don't look at the Nasdaq. I really look at bond yields because I think that it's going to be the single variable that is going to drive other asset classes and definitely equities in that way.
And as far as inflation goes, we saw earlier the super cycle of commodities. Right now, metals are under pressure for a very different reason. But another pocket that became very expensive, but a pocket that the markets like, was FMCG. Would you say, those kind of stocks could be under threat simply because of inflation? You've already seen a veiled profit warning of sorts from the top boss of Nestle India as far as tea prices go, milk prices go, coffee prices go. Won't all of this have a rub-off effect then?
Yes, definitely. It does have an effect on margins because the raw material cost goes up. And that goes for a lot of industries, whether it's auto, whether it's FMCG, anything agri-based. Crude is a very, very, very big input for the Indian economy as a whole, which we import. So what really happens is that it starts affecting margins and the margins start getting compressed. And already, as you rightly pointed out, we are seeing or hearing managements talk about it. And that will kind of reflect in numbers. That's again coming back to the earlier point that, hey, is this transitionary or is it structural? If it's transitionary, the market will forget about it and think that, okay, the margin compression is a quarter or two, and then, dust off and move on. But if it is structural in nature, I think the Excel sheets will have to be reworked and margins will have to be compressed. And that would affect, I feel, some of the stocks where obviously the Ps are very high because these are the names that you mentioned, which may not justify and a little bit of compression that may happen out there. But that is, again, as I said, step number two. The issue itself is that is inflation transitionary or is it structural? If it's transitionary, no problem. The market will dust itself and move on. If it is structural in nature, it could cause a bit of pain. Yes.
Okay. The volatility in the metal stocks today, let's look at the intraday graph and just look at Tata Steel. I'm using that as a leadership stock here. Look at how it has moved just today. And we've 10 minutes into a conversation with Atul, 15 minutes into the market open, and look at the graph. Up, down, up, down. That's typical metals for you. And, I can speak out of my personal experience that when you see volatility, typically it means that buyers and sellers are trying to arrive at a price and the buyers and sellers are not able to arrive at a price. So something is going to change. Whether after this 10-15% fall, buyers will come back and say, look, metals is the long-term trend. They will come back and the price will settle. Or the sellers would say that, look, I think the trend is going to remain weak for some more days and we're going to be putting it down. Historically, Atul, something which I've learned from a very dear and common friend of ours, that when there is volatility, after a big move, it is indication of a trend change because the buyers and sellers are trying to arrive at a price.
Well, it need not be a trend change. It could also be a bit of a correction. Because as I said, that when I look at commodity charts, and I'm talking about global charts, I think that when you violate a 10-year, 12-year downward trend line or a downtrend, I think that there is a lot more that can happen. So metals, what you're seeing on the screen, Nikunj, is a typical nature of that asset class. It's typically off metal stocks. The dream run that we had in metals, which were one way up, is something which really happens, but rarely in metals. But metals tend to be very, very volatile. That is why you'll find most fund managers have great difficulty in having overweight metal positions, simply because the volatility in portfolio is very high. So I think this is typical nature of the beast, and you will have this kind of short-term volatility. I personally don't think that it is a turnaround in the trend, because when I go back and look at decadal trends, I realize that it's actually a very, very big move that has happened. If it corrects 10%, 15%, it's fine. It's like I look at the CRB index, right? The CRB index, as long as it's above 200, I think things are okay. Metals can correct and again have a move up. Commodities can correct and have a move up. But volatility, as you see it on the screen today, is very much a nature of this. You will not see such volatility in maybe an IT stock, or maybe definitely not in an FMCG stock. And this is very much a nature of metals as a sector. And as I said, that is why the kind of people or the crowd metal stocks attract is very different. People who are very fast, who can change their position, buy, sell very fast. Whereas most people prefer structural stories. That is why, as I said, people are very hesitant to be overweight metals in their portfolios.
Godrej Properties is up 6%, DLF is up 3%. So it's not that there is risk off everywhere. Atul, metal was into a multi-year bear market. It came out, now it's a bull market. Will the same theory, let's say, apply for real estate? Multi-year bear market followed by a big bull market. Will the same theory apply for telecom? Will the same theory now apply for even a sector which we represent, media?
Yeah, so I think it's very interesting. I feel if you look at the real estate sector, you realize that post 2008, it's been again fall. It's been a decadal consolidation. The consolidation has been going on for 10, 12 years, and it is definitely pushing to the upper end of the bracket. Now, when you look at the construct of the index per se, based on the weightages, you realize that DLF actually pushes a lot of weight. However, if you convert this, I'm speaking a little technical, but you convert this into an equal weight index where you take away the weightages given because of market cap, you realize that it is not so bad, because there are a lot of real estate stocks which are at lifetime highs. So as a sector, because you look at the NSE real estate index, you find that, it has been into a massive consolidation. But if you look at the components, you'll find that a lot of them, actually 80% of them, are doing very well. It is just that the weightage of one or two stocks which is pushing the index right down. So what may look like an illusionary underperformer, which is real estate, actually is not doing so bad. And you can go out and see that many stocks are pushing to lifetime highs. So there's a lot happening in real estate stocks which is not being covered or reflected in the index. Same also with telecom. It's again the play of weightages, that there is just one or two stocks actually change the whole flavor of that. So you're absolutely right that these are decadal underperformances which are doing a very big catch up. And I personally think that there is a lot of juice still left in them. And the true test of these sectors or how they do is that the day markets correct. When there is euphoria, people want to buy anything and everything. But when markets correct, which we are experiencing right now, you'll realize that if these sectors fall less and they're first to rise, that is a typical characteristic of change in trend, of change of leadership. So corrections also are great times to do research, because stocks that fall less in falling markets are leaders of the next bull market. And we are seeing that. And the next bull market, which I said, is the third phase, which can be pretty far away. But the seeds of that, or the research for that, is actually done in consolidation. So in consolidations, we look for those sectors and stocks that fall less when markets fall and rise more when markets go up. And I think that should be the mantra, or that should be the strategy for the next few months.
Great to have you on the show as always. But,
Thank
just
Thanks for
looking
having
at the reopened trade, everything from aviation to hotels holding up, I was wondering whether the perpetual Atul Suri, the traveler, is back to traveling or not.
In fact, I'm traveling twice a month nowadays. And it feels so good.
Okay, no wonder then the stocks are holding up. I'm sure. Okay, great catching up with you as always, Atul.
Thank you.